You're hovering over the exit button on your platform, 3 monitors glowing like a casino. The 1-minute candlesticks are sprinting. The 5-minute just printed a doji. The 15 is tapping a moving average, and the hourly is still bullish from the morning gap. Your short position bleeds 2 ticks, then 4. Your stop loss is in, then out, then wider, then back where it started. The cursor wobbles, an alert pings. Level 2 flashes a phantom bid. You tell yourself to wait for the candle to close, then you can decide. Another wick forms. Now the 3-minute shows momentum diverging, but the 15 still looks fine, and the hourly says, patience. Your finger hovers over the flattened key. You're not trading the position anymore. You're negotiating with your fear across 6 timeframes. You glance at the daily out of habit, as if a slower candle could bless your scalp. It feels responsible, even professional. But the more charts you open, the less your hands obey the plan. Here's what's hiding under those extra charts. Your brain is a prediction machine built to find patterns in noise. Add timeframes and you multiply apparent patterns, creating confirmation on demand. That feels safe, which is why dopamine spikes on every green candle and new confluence. The moment P and L turns red, cortisol floods the system, and your threat circuitry hijacks deliberate thinking. You don't just overanalyze, you identify as thorough, exactly the trap Mark Douglas described. Beliefs that protect you from pain while distorting market information. So you keep looking for a time frame that makes the loss feel temporary, the stop loss feel unnecessary, the exit feel premature. You call it diligence. Your biology calls it relief seeking. Most traders lose money not because they lack indicators, but because their beliefs and biology collide during live risk. The market doesn't care how many charts you check. It only pays consistency and execution under uncertainty. Past patterns don't guarantee future outcomes, and piling on timeframes doesn't change that. Brett Steenbarger calls this functional fixedness. You cling to an analysis routine because it once worked, even when the regime changes. Now the paradox bites, more screens, less clarity. You feel informed, yet you hesitate at the entry, you flinch at the exit, and you widen stops when a slower chart suggests room to breathe. That room often becomes a drawdown you didn't budget for. On volatile days, adrenaline compels faster switching between charts, which magnifies noise. Mirror neurons make it worse. Watch a chat room panic, and you'll feel an urge to change your plan, even if your setup is intact. The longer you stare, the louder the limbic system talks. Your eyes are on candlesticks. Your body is in fight or flight. There's also a probability failure. In Trading in the Zone, Douglas hammers the idea that each trade is a unique event with a random distribution of outcomes. Multiple timeframes trick you into believing a single outcome is inevitable. So you hold a loser because the hourly trend is still intact. Or you dump a winner because the 1-minute printed a red bar. You're treating contradictory data as if it changes the bet after you've placed it. It doesn't. Only your predefined risk and location matter. Finally, the behavioral loop. Entry hesitation paralysis, exit greed extension, stop loss removal syndrome, and revenge trading loops. Each is reinforced by your nervous system. Dopamine drives the chase for perfect alignment. Cortisol punishes small unrealized drawdowns, so you override the plan. Serotonin depletion after losses shrinks your confidence, making you add more charts for comfort. The result is the trader's paradox. The best trades feel uncomfortable, and the most comfortable trades, full of confluence and agreement, often arrive late, with poor risk-reward and sloppy exits. You think you're adapting, but you're appeasing fear. The extra chart becomes a permission slip to break rules you wrote when you were calm. Each deviation looks harmless in isolation. In aggregate, it's your equity curve bleeding by 1,000 tiny cuts. Let's name the costly pattern in detail. It starts with entry hesitation paralysis. You insist the 1-minute trend aligns with the 3 with the 5 with the 15 with the hour, and the hour with the daily. While you wait for the planets to align, the setup triggers without you. You chase an inferior entry with a worse price, shrinking risk-reward from 2 to 1 to 1 to 1. Next comes stop-loss removal syndrome dressed up as higher time frame structure. You widen the stop because the hourly support sits 12 ticks lower. That wasn't part of your plan, that was part of your panic. Now exit greed extension shows up. The 15-minute target hits, but the daily looks like it could trend, so you hold. A sudden liquidation flush erases your unrealized gains, and you exit on the 3-minute break, even though the 15 is still fine. You've traded every time frame at once and none with integrity. Layer in a red streak and you'll trigger a revenge trading loop. You drop to the 1 minute to get it back, stacking micro trades with micro logic until your daily max drawdown is gone. The paradox sharpens. Tighter stops become bigger losses when they're arbitrary. More analysis becomes worse execution when it's used to soothe discomfort instead of define risk. Meet Marcus, the algo hybrid, 2 27-inch screens and a laptop, trading view for charts, a futures DOM for order flow, and a rules panel he coded that turns green or red only when conditions are met. He blends systematic logic with human discretion. Data to find the setup, human to execute the entry. He holds positions minutes to hours, flat by the close unless his system tags a swing. Marcus used to be the king of timeframes 1, 3, 5, 15, 60, daily stacked like a wedding cake. He could narrate any candle in any direction. He blew 2 small accounts and nearly torched a third on margin during a volatility spike when the 1 minute screamed exit while the hour begged hold. Most traders lose money. He was on the wrong side of that statistic because he was trading feelings in the costume of analysis. He rebuilt from the ground up after reading The Way to Trade on Systematic Discipline, revisiting Douglas for belief work, and mining Trading Psychology 2.0 for process. He stole a page from Market Wizards. The greats simplify what they watch and multiply what they do well. So he hard-coded constraints. Set up lives on the 15-minute, a pullback to prior value with order flow absorption, and RSI divergence only on that chart. Entry belongs to the 3-minute, single confirmation, reclaim of the micro swing with volume through resting liquidity. Stop loss is mechanical. Last 3-minute swing low or high. No moving, no exceptions. Exit is binary. Either the pre-mapped 15-minute target prior high, prior low, or VWA P-band, or a 3-minute structure break. Position sizing's probabilistic. 1 risk unit per trade, scale to 2, only after partial at 1-to-1, and trail built. He treats emotions as data points. If adrenaline spikes, he size caps. If he feels the pull to check the hourly, he tags it in the journal and does nothing. He keeps a tilt breaker from the disciplined trader. 3 rule breaks in a session equals instant flat and walk. Marcus keeps level 2 and volume profile only to answer, is someone absorbing here? He refuses to ask different timeframes to rescue bad locations. He reminds himself daily, more analysis can mean worse results if it dilutes execution. He still feels all the chemistry dopamine on green flashes, adrenaline during fast tape, the cortisol spike when red, but he routes it through rules that don't negotiate. His motto sits on a sticky note above the middle screen. Emotions are data points, not instructions. How do you rewire out of timeframe addiction? Start pre-market with a constraint. Pick 1 timeframe to define the setup and 1 timeframe to execute entries and exits. Write them at the top of your plan and remove the others from view. Build a rule that your stop loss, target, and invalidation all come from those 2 only. Create an alert ladder so your platform pulls you. You don't chase it. Price into zone, reclaim or rejection, trail trigger, exit hit. Journal the biology. Mark the moment you feel the dopamine craving for confluence, the cortisol urge to widen the stop, the adrenaline spike during volatility. Annotate what your rules demand instead. Second, audit your exits. Export the trades where you change the plan after consulting a different time frame. Tag the P&L difference between the planned exit and the new exit. That number is your confluence tax. Third, codify paradox rules. Best trades feel uncomfortable at entry. Tighter stops often lead to bigger losses if they're arbitrary. More screens can mean less clarity. Translate each paradox into a checklist line you can recite at the button. Fourth, simplify the stack. 1 setup time frame, 1 execution time frame, 1 tool for context, volume profile or DOM, and 1 momentum gauge. If an input doesn't change risk, remove it. Fifth, turn best practices into best processes. Make the routine inevitable. Pre-market map, alert ladder, 2 charts only. Rules panel visible. Position size fixed. Exit logic printed. Review at the close. 6th, protect your attention. Mute social feeds. Kill HTF bias chatter. Mirror neurons don't get a vote in your risk. Finally, harden risk culture. Pre-commit to maximum daily drawdown and number of trades. If hit, you're done. Most traders lose money because they negotiate with pain. You'll stop negotiating. Not financial advice. This is performance process. But the effect is financial. Fewer impulsive exits, cleaner holds, smaller drawdowns. Past patterns don't guarantee future results. Yet a repeatable process gives randomness less room to ruin you. Picture your transformation. 2 clean charts, not a cockpit. The alert fires. Price tags your 15-minute zone. The 3-minute reclaims with volume through resting liquidity. You take the position. 1 risk unit, stop placed. The 1-minute spikes, but you don't see it. The 5-minute prints a scary wick, but you never gave it the power to veto your plan. Your heart jumps, you breathe once and say out loud, exit on 3-minute structure break or 15-minute target. 10 minutes later, partial at 1-to-1. You trail under structure. The 15 taps, VWAP band. You ring the rest. No drama, no extra charts. Your journal notes. Discomfort high, execution clean. The paradox is intact. The best trades felt uneasy. The results were calm. Tomorrow you'll do it again. Same 2 timeframes, same alert ladder, same stop logic. You'll still feel dopamine when the green bar pops and cortisol when a candle turns against you. That's human. The difference is that your rules decide, not your chemicals. You won't widen stops because an hourly line whispers seductively. You won't dump winners because a 1-minute blip shouts. You'll trade the location you planned and accept the randomness you can't control. Risk management is survival, not entertainment. Most traders lose money. You refuse to fund that statistic with your exits. And as your screens get cleaner, your decisions get faster, your drawdowns get shallower. And your belief system finally stops looking for comfort and starts rewarding discipline.